Hey taxpayers, and welcome to my studio. And at the time of this recording, it is currently toward the end of August 2021, which puts us at about month 17 of 2 weeks to flatten the curve. Now, unless you've been watching the news here recently, chances are you probably guessed that COVID is not going to be stopping anytime soon, which is actually putting additional pressure on employees and businesses to have their workforce working from home. So, if you're working from home, how does this really affect your taxes? Now, the reality is that the home office deduction is actually fairly complex. It's not a one-size-fits-all, and there's a lot of different criteria that needs to be met. So there's actually no way I can cover everything in this 25-minute video. So actually, if there are questions, please look at the IRS publication 587, because that is probably going to be your source of truth, and it's actually updated when there's new things that are being developed. Now, at this time, this video is only going to be talking about what is actually current tax law. But again, with everything going on with COVID and everything trying to be pushed back to working from home, everything is on the chopping block that could be subject to change. So again, publication 587 is going to be your source of truth because it's going to be updated as things happen. Again, try to avoid just Googling what home office deductions, because yeah, some of those articles are written by accountants, but no offense, sometimes they are journalists, and journalists don't sign off on tax returns. So again, publication 587 is going to be your source of truth. Look at that, because again, I can't cover everything in it in just a short amount of time. So what exactly is the definition of a home office? You would think it'd probably be a pretty simple one, but in reality it's a lot as simple as we think. So the first thing is, let's break it down the word. So in this case, home. Home is just any place that serves any type of living accommodation. So in reality, we would all think it would be our home where we live. Now again, it doesn't have to be necessarily a home. It could be a condo, it could be a boat, it could be a trailer, it could be an apartment. Wherever that you personally live as your residence would qualify as a home. Now let's jump to the term office. Now, office does not necessarily have to be a completely segregated area of a house. So it does not have to be something that's separated by four walls, nor does it have to be partitioned off by like those temporary cubicle cloth walls or anything. It could be something as simple as just like a nook or just a section of a corner that is designated for your work or your trade or business. So again, it does not have to be, again, a completely separate room that has to be adjoined by a door or surrounded by four walls. Again, it could be something as simple as, like I said, a desk that's placed in the corner of a larger room. If that desk is, again, designated for that space or again that business, then that would be considered an office. Now that we kind of got an understanding of what a home office is, let's see if what we have actually qualifies as a home office. Now, there's actually two main keywords we really need to be worried about in order to make sure that what we have is actually a home office, and that is designated and exclusive. Now, designated is a little simple. It basically just means that you have a space that is assigned to do your work. Now, technically, this is a little crazy because in this day and age, you could essentially have a job or, again, a side hustle or whatever, where all you need is literally a laptop. You don't need a second monitor, you don't need a printer, you don't need any filing. So if you just have just a laptop and all you do is, let's say some days you may work in the basement, some days you work in the living room or den, whatever. Sometimes you work at the local library. If that's the case, then you really don't have an assigned or designated space. So if that's the case, you really don't have an option of taking the home office deduction because you don't necessarily have a home office. You can't claim the entire house as your office because some days you work one location and then other days you may work in another. No, it has to be a central, again, designated space that you use for your business. Now, if you have a desktop where you can't just pick it up and move it, that's a little bit easier to substantiate because, again, that's something you really can't move around and it's not very mobile. So if that's the case, you have a better chance of defending yourself by saying, yes, this is a designated space because all my fixtures are right here. Again, my desk is here. Now, granted, personally, mine are laptops, so I can pick up and move fairly easily, but at the end of the day, this is a designated space personally for me. Now again, designated is a little simpler to understand, but exclusive is not so much. Now the exclusive test is a little bit more stringent and a little bit more aggressive, because now that what this is saying is, now that you've identified a designated space, that designated space has to be exclusive to your work and trade or business, and virtually nothing else can be done inside of it, or else then you are disqualified for taking a home office. And the stories that I've heard actually can get pretty in the detail. Now, I would do like an MTV Cribs montage where I would show you the room, but I'll be honest, I have not cleaned this room. But just to kind of give you an example, my office here is 10 by 10 feet by 10 feet, so 100 square feet roughly. But right beyond the back of this camera is a Murphy bed, so this is actually a separate guest room in a sense. It's also got some exercise equipment. It's got a computer for my kids to play with. So at the end of the day, this room is not just used for my accounting work. It's potentially used for, again, if there's bad storms and this is just an extra room. Again, my kids will come down here and play, and this is where I come to maybe kind of do some workouts. And if that's the case, none of those activities actually applies to my business. So I for sure cannot say that this 10 by 10 room is exclusive to my job. And because of that, I cannot take a 10 by 10 deduction on this office. So again, that does not meet the exclusive test. Now, taking it even a step further, a colleague of mine actually told me a story where this individual, was an empty nester. They didn't have kids that, would come into a room and, use it for fun. And if that was the case, they would lose the exclusive also. But basically, they had a home office, and when they would have friends over, they would actually open up the office doors and extend the dining room table into it so people had places to eat. Well, this particular client actually told their auditor that, and immediately they lost the entire deduction, because even though it was a designated space for their office, and that's all where this gentleman did his work, the fact that he used it as an overflow for, again, guests to eat did not make the exclusive test, and because of that, they lost the deduction and it was disallowed going forward. So again, as something as simple as that can remove you from the exclusive test. Now, a few minutes ago, I did mention that a home office does not have to be something that's segregated by walls. It could be, again, a nook or, again, a corner where you have a place set up. If that's the case, you have to be very careful that you don't cross some veil that's leading into other activities. So again, another situation is, let's say you have a basement that is 1,000 square feet. All you have is just a little corner desk in the corner, maybe 6 square feet at the most. Again, you don't really do anything beyond that corner for your business. But let's say a few feet down is a washer and dryer, where, again, your family does their laundry, and that laundry has nothing to do with your business or trade. If that's the case, and you really, really want to take a home office deduction, you cannot go on beyond and account for that square footage that laundry, that washer and dryer is included. So even though your room that you're in is 1,000 square feet, or whatever example I gave, you can't take the whole amount because there's stuff in there that's not exclusive to your business. So in reality, your exclusivity for your designated space is really only like 5 or 6 square feet, which is virtually nothing. So again, exclusive is pretty stringent and, again, very aggressive. You have to be able to prove that your space is only designated for that activity. Now, I guess just to elaborate this further, there's actually a pretty good movie with Ben Affleck called The Accountant, which actually is a very true life story of how accountants work. We usually do our books during the day and we moonlight as assassins at night. Now, there's actually a scene in here that's very realistic where Ben, as a tax practitioner, is sitting down with a client and prodding them with questions on their tax information, which is extremely, again, realistic. And I guess that's a side point. If your tax preparer isn't asking you a lot of questions, find yourself a new tax preparer, because our job is to pretty much unload a bunch of questions on you to make sure that we understand exactly and we know what's going on. So let's take a look.
Do you like it? I made it myself.
No, not particularly, but do you ever sell one?
At church fairs now and again.
Mrs. Rice, you might have what the IRS calls a home-based business. What room do you use in your house when you make those?
I don't really, just wherever I happen to be, I guess. in front of the TV at the kitchen table. I like to spread my beads out in the dining room, but Frank gets
Yes, it would be better if you could try to remember the one specific space that you use. Your home is 2,913 square feet. IRS code allows us to deduct from your taxable income a percentage of your workspace relative to your overall home.
What?
Mr. Rice, how big is your dining room? Mrs. Rice's office.
I wouldn't so much as call it an office.
It's approximately 200. Well, make it 300 square feet. Excellent. Mrs. Rice?
Dolores.
So thinking about that designated and exclusive test we were just talking about, Ben is actually doing a pretty good thing with his client by actually trying to say, hey, remember that one specific spot you were doing your job? Now he's actually trying to help the clients meet that designated spot. Now granted, that is kind of unethical because if the client says, hey, I really just kind of work wherever, the practitioner is really supposed to just take that information and go with it. But I guess in this case, he's saying, hey, are you sure you don't have that one spot that you work in? Now at that point, again, that would be pretty normal. But here's my problem. The exclusivity test on the dining room is going to be extremely difficult to prove. Basically, what they're saying is if Ben's going to be able to get the office deduction for this individual who does, again, this side business, probably Schedule C jewelry making, the thing is that even though that they are going to say, hey, they use the dining room for this job, the moment that family puts down a stuffed turkey and buttered rolls on that table and eat in the dining room, then they lose that deduction because at that point, the dining room, again, which was now the designated spot for that job, no longer is exclusive to that jewelry making or that's scene. So in this case, Ben's in the wrong here. Again, one of the things we have to do is talk with clients and make sure that we can kind of get them where they need to. But specifically saying that, hey, yeah, you can use your dining room as your office, that's an extremely far stretch that I don't think we'll be able to hold up if in fact an auditor is going to come in and say, hey, are you saying that you use your dining room exclusively for jewelry making? I really have a hard time believing that. And that's something that you as a client is going to have to be able to prove. And good luck with that because, again, dining rooms are usually pretty, a lot of stuff goes on in there. Now, taking a step further, once you determine that you do have a designated and exclusive spot, one of the ways that you can calculate a deduction, which we'll explain a little later, is by taking the square footage, which again, Ben is asking the clients here for. In this case, they say a certain number and then he says up. At this point, again, we could argue that, okay, we really probably don't know the exact square footage of a dining room because dining rooms are very seldom just sectioned off by four walls, usually they'll probably be like an open archway or whatever, and that can kind of get a little bit of gray area. But just to specifically say, yeah, bump those numbers up, that pretty much is fraud in the first degree. So that's pretty much the textbook definition. Again, at that point, it's pretty much crazy that you would probably be saying, hey, let's just bump our numbers up so we get a higher deduction. Now, granted, in the event of an audit, an auditor probably won't be bringing a tape measure with them, but it has happened before. And if you say that, hey, my dining room's 200 square feet, they come in and they measure, oh, this is only 100. A reasonable person could probably determine the difference between a 200 square foot room and a 100 square foot room. And if that's the case, again, you're probably going to have to be able to not only prove to the auditor, oh yeah, my dining room is not only exclusive to my jewelry making business that I just do on the side, but also it's 200 square feet and now they have a tape measure with them and now you've got to be able to defend that self. So a good scene, but I probably would not want to be in those clients' shoes. Just be on the heiress caution. Now, there's actually two major exceptions to this whole designated and exclusive test, and that is if you house and store inventory and if you have a daycare. Now, inventory is a little different because personally, I have never signed off on a return that had storage of inventory within their house. But really, the reality is if you buy and sell inventory and your office is separate than your storage, or if you have enough that you have a storage, then those two are actually kind of added together. And again, please read publication 587 because again, inventory is kind of treated a little bit differently. But again, even if you have inventory, let's say stored in like the garage, even though the garage is probably used for other things, the fact that it is storing, it does actually meet the exclusive test, even if you say park your car in it or use it again to like kind of work out or something. And assuming that working out has nothing to do with your buying and selling. Now, also to keep in mind that inventory is bought and sold. It is not bought and then used up by you. So one situation that I have run into that actually I feel like I've heard other people say is, let's say you own, or I should say own, I guess you do kind of work on the side on vehicles, like you're kind of like a side mechanic, and you work out of your garage. Even though your garage, whether it's attached or detached, that could be very simple to assume a designated space. However, if you say park your personal car into it and all that kind of stuff, then it's going to be a little trickier to prove exclusivity. But let's say you buy your own tools, which you probably would have to anyway if you run out of your garage. But you buy your own tools and say that, okay, these are inventory. Well, they're not inventory because, again, inventory is bought and then sold. You're essentially a middle person or a retailer. If you are, again, someone like a mechanic, then you're not a retailer. You are essentially you're providing a service. So if you buy tools and you keep them in your garage to work on cars that are going to be coming in, you're not selling the tools, so you're not housing inventory. You're essentially just buying equipment that you're using up. So again, inventory has to be bought and then sold. Again, that treats you as the retailer. And again, things like if you're a mechanic, that does not count because you're just buying the tools and then using them as they come in. So they're not considered inventory. They're, in this case, probably equipment or supplies. Now, the other huge exception is daycares. Now, if you know anything about a daycare, it's virtually impossible to have a designated and exclusive space because, let's face it, kids are running around. Now, that's also another important point. It does not necessarily have to be kids. Now, in this case, it could be, again, mostly children, but it also could be the elderly, and I believe the age is 65. I'm going to really have to put something down in the description if I'm wrong there. But if you're taking care of anyone that's over the age of 65 in your home, or again, children, or if anyone is some sort of developmental disability or physical disability that you take care of, those three actually qualify as a daycare. Going along with the daycare, there's actually another big part of that. Not only do you have to take care of children or the physically or mentally disabled, again, or anyone above the age of 65, but you also have to have applied, been granted, or been exempt from any type of certification or certification. So otherwise you can perform a daycare facility in your home. Now, if you have been revoked or never applied or have been rejected, then you do not get to claim any type of deduction for your daycare. So one day you wake up and you're saying, oh, I want to watch my friend's kids. You bring them over and you get paid for it. Even though you're probably using pretty much your entire house, you're not inclined or able to take any type of office deduction because you probably have not applied for some sort of certification. So that has to be done before you can claim anything. Now, with the daycare, it's a little confusing because, again, going back to the whole designated and exclusive, pretty much a daycare is not really going to meet these exceptions because, again, you'll use the living room for playtime, to watch shows, which again, after hours, same thing. Your family will do there for personal reasons. The kitchen will be used to prepare meals, which again will also be used to prepare meals outside of that business, outside the daycare business. So again, there's a lot of exclusivity that's not going to be met. Again, same with the bathroom. You're going to have to change whoever you're taking care of, which again, the bathroom's also being used for outside personal reasons. So if this is the case, it gets a little trickier to prove, I guess not to prove, but to solve for the actual deduction if you have a daycare. Now, I'll be talking about how to calculate deductions a little bit later, but more importantly, if you have a daycare, it's actually two parts. The first is you have to be able to determine the square footage, generally the square footage of the office or the areas that you utilize, which in this case is probably going to be a living room, like a playroom, probably the kitchen, maybe a designated bathroom if needed, like if you have to give baths and so forth. Then you take those square footages, and then you have to find the allocation between hours of personal time versus the daycare time, which sounds easy, but it can kind of get a little cumbersome. But one way to think about it is, let's say you watch kids, let's say 5 days a week, 52 days of the year, and you watch them for 8 hours a day. So in this case, that's 5 hours times 8 hours a day times 52 weeks. So that is, that's 2,080 hours. That's how much hours are in a workday. That makes kind of sense. But so that's the hours that you work for your daycare. Then you have to divide it by the amount of hours that are totally within the year. And to figure that, we just take 24 times 365 or 366, it's of a leap year, and that'll get you around 8,000 plus hours. So if you say that you work 5 days a week, 8 hours a day, 52 weeks a year for daycare facilities, that means that you provide 2,080 hours of business hours in your home, when in reality there is like 8,000 plus hours during the year. So you take that 2,000, you divide it by the amount of hours in the year, which in this case 8,000 plus, and then you get an allocation or a percentage of the amount of hours that you have worked for your daycare facility. In this case, then you would take the amount of your house allocation, which again, your square footage that you utilize for daycare activities, divided by your total house, and then you have to do another allocation based on the amount of hours. So again, I'll probably have some sort of explanation here because I actually didn't write down an actual example ahead of time. But daycares, you have 2 allocations to do. Not only square footage, but time, just because, again, daycare facilities are different because it's very difficult to have exclusivity in designated spaces if you're running a daycare. Now that we kind of understand what a home office is and if what we have is eligible, meeting those 2 criteria, the designated and the exclusive criteria, or if we have an exception, now do we actually get to claim it? Now there's really 3 categories we can talk about here. There's employees, there are self-employed, and then there are contractors. So let's just go ahead and start with the big one. If you work for a company, let's say Company X, and you're an employee of Company X, which means that you're given a W-2, then I'm going to go ahead and just say you don't meet any criteria, or you don't meet the eligibility for a federal office deduction on your federal return. Now, some states still do allow it, so again, make sure you understand your state tax laws, because there very well could be a office deduction if you're an employee for your specific state. But in this case, back in the tax year 2018, there was a big tax law change signed by then President Trump. And one of the things that was removed was what's known as the unreimbursed employee expenses, which does meet the criteria for, say, certain home offices. So again, if you are an employee and you receive a W-2, which by law, if you're an employee, that's what you would get. If you receive a W-2, then pretty much any type of cost that you pay out of pocket that you're not reimbursed for, so like if you buy printer paper or you buy notebooks or your pens or whatever, things that you paid out of pocket to benefit, again, your job as an employee, there's no deduction for it. On your federal return, your 1040. Certain states still have them. Honestly, personally, I have not seen any states that do them, but I've only do a handful of states here in the Midwest. So again, outside the Midwest, there may be more, but personally, I have not seen any. So again, if you're a W-2 employee, sorry, you were removed from getting any type of office deduction. Now, the 2 other categories, if you're self-employed or you are a contractor, generally you would not be paid a W-2. If you're completely self-employed and you pretty much don't receive any type of tax forms, you would probably have to be keeping your records independently. If you're a contractor, then you would probably be receiving 1099s, more than likely a 1099 MISC or 1099 NEC. If you are receiving a 1099, that is an indication that you are not an employee, that you again are a contractor or self-employed or whatever. And at that point, then you can qualify for the home office deduction because, again, like I said with W-2 employees, that was for unreimbursed employee expenses. If you receive a 1099, then you're not an employee. You're, again, contractor generally. So when that's the case, then you could probably take a look at taking the office deduction at that. All right, so let's actually now start calculating the actual deduction. Now, there's really two main ways of doing it. There's the simplified way, and then there's the actual way. The simplified way is much more straightforward. It's simpler given the name, but again, there's a little bit of things we have to take into account. The simplified way is that you take $5, which is a prescribed rate, we can't really change it, times the square footage up to a max of 300 square foot. Now, granted, that's by month, so at the max, that would be what, $1,500, so $5 times 300. But since it's looked at by month, you have to actually keep track of your by month, and in the event that the job or trade that you're doing is seasonal, or things change kind of with that. So, like for example, let's say you're a tax preparer, where your job really is only from January to July. And you don't really do anything else outside of that. You don't do like any type of consultation. So let's say hypothetically from January to August is your time. So in this case, your office is 100 square feet and you utilize it both designated and exclusively like we learned earlier today. So in this case, it's 100 for 7 months. And then for the rest of the year, it's 0 for each month after that. So in this case, it would be 100 plus 100 plus 100 plus 100 plus 100 plus 100 plus 100, now that we're in August, plus 0 plus 0 plus 0 plus 0 plus 0. So again, that's the 12 months that was allocated out. Then you add them all those together, divide by 12 to get your true deduction, or I guess the true square footage, again, allocated for the entire year. And then you take that number times 5. Now, again, that's the simple methods, which again, sounds pretty simple, but actually a lot of people tend to go with the actual method. Now, the actual method is a little bit more straightforward, but it's not as simple as the simplified method. With the actual expenses method, you actually had to take the actual expenses and allocate them directly to your square footage or that proportion of your house that is designated for the office. Now, in this case, you'll have to do a number of different things. The first is, just like what you did with the simplified method, is figure out the square footage of your home office. So in this case, hypothetically, let's say it's 100 square feet. Our total house is 2,000 square feet. So 100 square foot office on top of a 2,000 square foot home. So that's 5%. So 5% of our house is designated for, again, for our home office. Now at this point, now that we've got the allocation, now we've got to determine what expenses can be directly linked to the home office versus what cannot be, versus what can be designated only for the home office and not allocated. So again, there's 3 categories here. So for example, let's say again for our house that we pay someone to come over and mow the yard. So again, since our business has nothing to do with landscaping or whatever, then more than likely I can almost guarantee you that the cost of landscaping is not going to be anything that you can allocate to your home office. So costs like that are unallowable. Now, let's say you had a something that was specifically linked to that home office. So in this case, let's say hypothetically, I want to get these monitors up into the wall. In order to do that, I have to bring an electrician to run the wires, reroute the outlet, and all that. So that's probably going to cost me, let's say, $500. Since that $500 was specifically linked to this home office, and it was for the betterment of, again, my trade or business, then that can be allocated 100% to, again, my home office. So that is something that I can take. Now, granted, things like utilities, like, again, your water, heat, and all that fun stuff, since that cannot be, again, 100% related, linked to your house, then that is something that's going to have to be allocated out. So in this case, 100 square foot office, 2,000 square foot home. So 5% of certain utilities can be written off again as a home office. Now, certain things that are not as simple to allocate, or I guess I take that back, even simpler to allocate other than just taking 5% would be things like a home security system. So let's say that your office had a window and you have 10 windows in the house and you were quoted $300 to install security latches or whatever, or sensors on each of the windows. Well, again, you had 10 windows in the house. You paid $300 for window security. If that's the case, then you can argue that $30 of that cost went directly to the betterment of the office. Even though, again, 5% of your total house is the office, but the fact that one window out of 10 for the entire house was used, then we can actually take 10% again of that security cost as a deduction. So if you learned anything from this video, you probably got that the home office deduction is actually pretty complex, and actually I probably only scratched a little bit of detail when it comes to this video. Like I said, check out the IRS publication that I mentioned at the very beginning of this video, which again would be publication 587, which has a lot more detail, and thankfully, since it's even a government publication on a government site, it's actually updated when things change. So again, that's going to be your source of truth. Again, what I've just talked about was only true as of today, which again, the home office deduction is probably on the chopping block for updates and changes, especially as the world is changing around us. But again, one other thing to really keep in mind that I completely skipped over was, now that we kind of understand how to get the deduction, keep in mind that if you sell your house, which had the office in it, there very well could be chances that you may have to pay tax on that, which virtually no article or anyone ever talks about. So a lot of people don't understand that. So generally what people will say is, going back to the whole 100 square feet to 2,000 square foot home. So 5% of your house is, again, assigned to, is your office. Some people will say that you have to take 5% of any gain you got on the sale of your house, which is incorrect. Now, what may happen is if you've elected to take depreciation on your house, whether you took it or not, then you have what's known as depreciation recapture, which means if you do sell your house, then the depreciation that you have taken before gets added back to income, which is then taxable. And again, virtually no one talks about that because, again, it's pretty complicated, and what I just talked about was, again, very high level. But again, home office deductions is actually pretty complex. Again, we'll see what goes on with the U.S. and how things are going to be changing up. Maybe things will get more simpler, maybe things will change, maybe things won't. But again, that's kind of high level how a home office works. Again, hope this helps. I hope I understand taxes a little bit more, but until then, happy filing.